Selling covered calls is like renting out your stock, and here's a simple explanation. Imagine you have 100 shares of a company stock. You sell a call option or a covered call. You offer someone the chance to buy those 100 shares from you at a specified price known as the strike price in the future. This is like renting out your stock temporarily. In exchange for doing this, for selling a covered call, you get paid a premium from the person that's looking to rent out your shares. Now, by selling covered calls, there's two possible outcomes that can happen. If the stock price goes up, the buyer then decides to buy your shares at the agreed upon price and you sell your stock at that price. You keep the premium you received and you also make a profit if the stock price has gone up. Or number two, if the stock price doesn't go up or it goes down. The buyer may choose to not buy your shares. In this case, you keep the stock and you still keep the premium you received. And what's great is that you can repeat this process and sell more covered calls as many times as you want. So in essence, selling covered calls is a way to potentially make extra money from the stocks you already own by letting someone else bet that the stock price might go up while you get paid for the option. So now that we're all up to speed on what covered calls are and how they work, listen closely. What would happen if you were to utilize this amazing income generating strategy of selling covered calls on some of the most popular covered call ETFs? Now what I'm saying is essentially selling a covered call on a covered call ETF. Well, in this video, I'm going to show you the exact math on how this works and how I personally do this and generate even more income on a monthly and yearly basis. And this might even blow some of your minds. Now make sure to stick around because you are not going to want to miss a thing. Right after you, please drop a like in this video and subscribe for more future content like this. Now first, to get a few things straight. When selling covered calls on covered call ETFs, there's going to be a few things you're probably going to notice. The premiums offered are not necessarily going to be that high because a lot of these covered call ETFs are just not that volatile and there's just not all that much option interest. But that doesn't mean that there still aren't some premiums to be earned and there still is not a strategy to be had. So now that we got that out of the way, let me go through some actual examples of what I've done in the past and what you could do also. So this right here, for example, is the JP Morgan Equity Premium Income ETF, known as JEPI. Now, JEPI is a great covered call ETF, and I've actually been holding JEPI for a long time now. JEPI does pay a dividend on a monthly basis, and over the last years, some of the dividends have been pretty high, some of them have been a bit lower. But generally speaking, still with a trailing 12-month dividend yield of around 9.71%, this covered call ETF is pretty popular for good reason. But now when it comes to covered call ETFs, what is the main thing that most covered call ETFs have in common? And again, I'm not talking about every single covered call ETF, I'm just saying a lot of them. A lot of the covered call ETFs have overall price decay, or they trade sideways for various reasons. Now, if you look at JEPI year to date, it's up around 1%, and with the holding breakdowns, it should be up much more in theory. Now, the reason on why a lot of these covered call ETFs have price decay over time is, of course, because they utilize covered calls. And by utilizing covered calls, you are capping the upside potential of a position, but not necessarily capping the downside. If we were to even look at QYLD, for example, the Global X Nasdaq 100 covered call ETF, it's sort of more of the same. On the max time frame, QYLD has pretty much done nothing but trade sideways, go up a little bit, and then trade down. Because once again, covered call ETFs have a capped upside, but not necessarily have a capped downside. And that's just based off of how covered call mechanics work. The final example I'm going to go through is the TSLY or Tesla, Yield Max Tesla Option Income Strategy ETF. Now this ETF offers massive dividends, even way bigger than that of JEPI or QYLD. But on the max time frame, this ETF is also down quite a bit. It's trading at $14.65, when back in November it was at $21.76, down around 32+% on the max time frame. So you might be asking yourself, well, how did I come up with this idea of selling covered calls on covered call ETFs? Well, it's for the exact reasons I just showed you a second ago. These covered call ETFs have a lot of great things to offer, such as massive monthly dividend and of course some downside protection when it comes to market turbulence. But one thing a lot of these ETFs have in common, like I said earlier, is a lot of them do have price decay long term. So if you were, for example, looking to be an investor in the JP Morgan Premium Income ETF, but you didn't want to have all the possible exposure to price decay, one of the great things that you could of course do is you could then sell a covered call on a covered call ETF, or sell a covered call on the JP Morgan Premium Income ETF. Now the way that this would work is just like any other covered call. For example, right now for the January 17th, 2025, $55 call for JEPI. Right now this call is offering around $1.33 or around $133 in premium. Now what this basically means is that you are willing to sell off your shares of JEPI at some time in the future for $55 per share. And for doing so, you are going to earn around $133 or so. And of course, you are still going to receive the dividends because you own the underlying stock. So this is an actual trade that I've made plenty of times over the years in my portfolio. Whenever I see a good entry point for something like JEPI, let's say it's at $55 per share, I would buy 100 shares of JEPI for $5,500. Because for the most part, I want the JEPI dividend exposure. I want to get paid the dividends on a monthly basis, and I'm not really necessarily concerned about upside potential for JEPI, because let's be real here, JEPI doesn't really have all that much upside potential anyway. But if I were to want to make that trade, I would then buy 100 shares of JEPI, sell the covered call, earn the $133, or $1.33 per share. So my true cost basis then is $55 minus $1.33 per share, which means that I actually, in theory, just bought JEPI for $53.67 per share. So right away, you're getting a lower cost basis because you are selling the covered call, again, in exchange for allowing the buyer the covered call the choice to buy your JEPI shares at any point from here until expiration date for $55 per share, which is perfectly fine to me because I already earned the premium. And even if I don't receive a single dividend, let's say that the buyer would exercise this call right away and my shares would be taken. That's fine. I earned $133 from the premium, and this is honestly a pretty low risk trade. Now, in the meantime, of course, if JEPI was to trade down, let's say you bought JEPI for $55 per share and you earned your $133 in premium. So your cost basis now, let's say, is around $53.67. Now, if JEPI goes down to $54 per share, well, you're still in the profit because your cost basis once again is under $54 per share because you bought JEPI at $55, but you earned the premium along with it. So basically, by selling covered calls on covered call ETFs, you're setting yourself up in a very low risk position to where you're hopefully entering a trade at a pretty favorable price, earning premium and then also earning the dividends along the way. And at some point in the future, if your shares were to get called away, no big deal. Because at that point, in my opinion, you already got more than you want to out of the trade to begin with. Now, what's even crazier, and this might be a little bit more advanced, you could even sell in the money cover calls, which that's actually going down below where the current price of JEPI is at, and therefore you even have more downside protection. But we could always save that for another video. Even something like QYLD, you could do the same exact thing. You could sell a cover call for January 17th, 2025, and you could sell the cover call at $17 per share. And by doing so, you're going to earn around $78 in premium. Now, QYLD is currently trading at $17.48. So in theory, you would only be earning maybe $20, $30 or so from where the strike price is, the premium, then of course the share price. But by setting up a trade like this, what you're doing once again is lowering your actual cost basis and therefore potentially lowering your risk of price decay long term. Because once again, let's be real here, if you do want to have exposure to the global funds, global NASDAQ covered call ETFs dividends, but you don't necessarily want to be as exposed to the actual ETF price and you want to have some downside protection, selling a covered call on QYLD could be a great option. Now, the last example I want to give is, of course, from the new popular YieldMax Tesla option income ETF known as Tesla. Now, like we talked about a little bit earlier, this ETF is down around 30% or so as far as the max time frame. And although Tesla doesn't have as far out of an expiration date, which means that the premiums are not going to be as high, you can still, once again, sell cover calls on this covered call ETF. So the way that this one would work, and this is actually a play that I made recently, just to test it out. Let's say I sold a $14 covered call on Tesla. Tesla's currently at $14.65. The amount of premium that I'm going to earn is around $68 per 100 shares, or $68. Now, I know what you might be saying, well, that's barely enough premium to even cover the actual share price. But the idea behind this trade is that if Tesla was to get called away in some time in the future at $14 per share, after my premium, I'm pretty much break even. But because TSLY does have a chance to move down in price, just like we've saw at times over the last 3 months, there is a good chance that shorting it by selling a covered call could actually even be profitable for the call seller. And of course, those dividends every single month have been massive. So by utilizing covered calls on covered call funds for a more conservative, less risky investor, it can help with downside protection and allow you to maybe get into some trades that you wouldn't otherwise be comfortable getting into. So I definitely implore all of you to poke around different covered call ETFs, check out what the premiums look like, and keep in mind they are going to be different. Something like JEPQ is going to have different premiums than JEPI or even than TSLY or QYLD, but the overall strategy pretty much is more the same. Selling covered calls in general is one of my favorite ways to earn extra money throughout my portfolios, and selling covered calls on covered call ETFs is a way that I've been able to help with downside protection and generate more and more income on top of the massive dividends that some of these covered call ETFs offer. But I want to hear from you guys down below what you think of this strategy, selling covered calls on covered call ETFs. Is this a strategy you would potentially test in the future? Or if not, let us know why down below. If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.